The idea of buying a rundown house, pouring in some sweat equity, and selling it for a massive profit. It's the alluring narrative spun on countless reality TV shows and whispered among aspiring investors. While fix and flipping appears to be the fast track to real estate riches. But here's a surprising truth that most aspiring flippers overlook. The majority of fix and flip projects don't deliver the promised windfall. In fact, many lead to significant financial losses and crushing disappointment. Before you even thinking about picking up a hammer or signing an offer, you absolutely need to understand why. The common mistake isn't a lack of vision or even a lack of effort. It's a fundamental misunderstanding of the true financial equation and the unseen complexities involved. Most people focus intently on the before and after pictures, and they might even get a decent estimate for the big-ticket renovation items. But what they consistently overlook are the soft costs and the time costs. They dramatically underestimate the holding costs, property taxes, insurance, utility bills, and loan interest ticking away every single month, while the property sits vacant. They forget about permitting fees, unexpected structural issues that pop up once walls are opened, and the significant costs associated with selling, realtor commissions, closing costs, staging, and marketing. A project that looks profitable on paper can quickly turn negative when these often ignored line items are factored in, turning a dream into a financial burden. Experienced investors don't operate on hope, gut feelings, or the latest HGTV trend. They operate with a laser-focused principle, the Maximum Allowable Offer, or MAO. This isn't just about finding a cheap house. It's about reverse engineering profitability from the absolute first step. True profit in fix and flip isn't made when you sell the property. It's made when you buy it. Professional flippers approach this as a rigorous business project with a predefined exit strategy and clear profit margins, not a speculative gamble. This demands meticulous due diligence, conservative financial estimates, and an intimate understanding of local market comparables. Not just what similar homes are listed for, but what they've actually sold for once fully renovated. So, how do you apply this disciplined approach? We use a structured, step-by-step framework to determine if a flip project is viable and what your absolute top purchase price should be. This approach often starts with a variation of the 70% rule, a time-tested guideline that suggests you should pay no more than 70% of the after-repair value, RV, minus your estimated repair costs. However, in hotter or highly competitive markets, this rule might need adjustment, but the underlying principles remain constant. Here's the detailed breakdown of the critical financial components you must analyze. First, accurately determine the after-repair value. This is paramount. It means conducting thorough comparative market analysis, CMA, of recently sold, fully renovated properties that are highly similar in size, style, and amenities within a tight radius of your target property. Do not rely on active listings. Look at IK closed sales. Second, I meticulously estimate all repair costs, rehab budget, get detailed bids from contractors for every single task, roofing, plumbing, electrical, kitchen, bathrooms, flooring, paint, landscaping. Be exhaustive. Crucially, add a contingency fund of 10-15%, sometimes even 20%, for unforeseen issues. This isn't optional. It's essential for risk management. Third, IA calculate all holding costs. These are the expenses incurred while you own the property, but before it's sold. This includes property taxes, insurance, utilities, water, gas, electric, any HOA fees, and significantly, the interest payments on any loans you're using to acquire and renovate the property. Project these costs for your anticipated renovation A+ sales period. Don't forget security costs for vacant properties. Fourth, or a factor in all selling costs. Once the property is renovated and ready, you'll incur costs to sell it. This typically includes real estate agent commissions, often 5–6% of the sale price, closing costs for the seller, title insurance, escrow fees, legal fees, transfer taxes, usually 1–3% of the sale price, and potential staging and marketing expenses. Fifth, determine your desired profit margin. What is your goal? A 15%, 20%, or even 25% return on your investment, or a specific dollar amount? This is your compensation for your time, risk, and capital. Once you have these numbers, the formula for your maximum allowable offer is MIOPKRV. Repair costs, holding costs, selling costs, desired profit. This formula helps you understand precisely what you can afford to pay for the property and still meet your financial objectives. Bob, you still meet your financial objective? Let's walk through a concrete scenario. Suppose you've identified a property in a desirable neighborhood. Through diligent research of recent comparables, you determine that its after-repair value, once fully updated, would be $450,000. Here's how the breakdown looks. ARV $450,000, detailed repair costs. After getting contractor bids and adding a 15% contingency, you estimate $80,000 for renovations. This covers a new kitchen, 2 bathrooms, flooring, paint, and some landscaping. Holding costs. You anticipate a 4-month renovation period and a 2-month sales period, totaling 6 months. For taxes, insurance, utilities, and interest on your acquisition and rehab loan, you project $12,000 for these 6 months. Planning costs. At 8% of the RV, 6% realtor commission, 2% closing costs, this totals $36,000. And desired profit. You're aiming for a solid 18% profit on the RV for your efforts and risk, which is $81,000. Now, let's apply our MAL formula. MAL to $450,000, RV, $80,000, repairs, G $12,000, holding, $81,000, profit, $81,000, $200,000, $250,000, $209,000, Gmail to $41,000. Gmail? If the seller is asking for more than this, or if you can't negotiate to this price or lower, then this particular flip is not a good deal for your defined parameter. This is the discipline required to succeed. While the immediate goal of a fix and flip is to generate capital, its true strategic value in a holistic, long-term wealth building plan is often found in how you reinvest those profits. A successful flip isn't just a single transaction. It can be a powerful engine for portfolio acceleration. The significant capital generated from a well-executed flip can be used as a substantial down payment for multiple cash-flowing buy-and-hold rental properties, or to acquire larger, more complex commercial asset. This transforms high-risk, active income from flipping into stable, passive income and appreciating equity from long-term rentals. It's about systematically converting generated capital into durable wealth, mitigating the higher risks inherent in flipping by diversifying into more stable assets over time. Thinking about how each flip contributes to your broader financial independence is key. Fix and flip is not a get-rich-quick scheme powered by emotion or optimism. It is a specialized, intensive business that demands rigorous analytical discipline, precise financial planning, and a deep understanding of local market dynamics. Those who consistently succeed approach it with a meticulously detailed spreadsheet and a sharp pencil, not just a paintbrush and a can-do attitude. By mastering the maximum allowable offer principle and meticulously accounting for every single potential cost, you transform a high-risk gamble into a strategic, calculated investment. Don't chase the glamour, chase the validated numbers. And if you're truly serious about building lasting, long-term wealth through real estate, start by understanding that your profit is made on the G-buy, not just the sell. Make smarter, data-driven property decisions, think long-term about your real estate journey, and build your wealth strategically. That's the Keystone Property Advisors way.